In the grand theater of speculation, the most difficult and most costly act is the final one, the exit. Any man can be brave enough to buy a stock, to place a bet on a future he believes in. But to know the precise correct moment to sell, that is an art form, a science that has eluded the vast majority of those who have ever attempted to play the game. The average trader is perpetually caught in a torturous limbo, torn between two equally destructive impulses. He either snatches a small profit too early, gripped by the fear that his meager gains will vanish, or he holds on to a winning position long past its zenith, paralyzed by a greedy hope, watching in agony as a great paper fortune evaporates back into the unforgiving ether of the market. This single, universal failure to master the exit is the primary source of all speculative ruin. Jesse Livermore, the master speculator, saw this problem not as a matter of luck or guesswork, but as a fundamental flaw in human psychology. He recognized that the amateur does not sell when the market tells him to, but when his emotions command him to. He sells out of fear or holds on out of hope. Livermore's entire career was a relentless quest to eliminate these treacherous human elements from his own operations. He sought to replace emotional impulse with a set of cold, calculated, and mechanically precise rules. For him, the perfect exit point was not a price to be guessed at the top, but a condition to be recognized, a signal from the market itself that the time for action had arrived. He understood that the big money in speculation was made by identifying a major trend and having the courage to ride it. But this courage was not blind stubbornness. It was an intelligent patience, fortified by the knowledge that his system would provide him with a clear, unambiguous signal when the trend was complete. He was not trying to capture the last eighth of a point, a folly he knew had cost traders millions. He was concerned only with capturing the great central body of the move and, most critically, with keeping the profits he had made. To accomplish this, he developed and adhered to three foundational exit rules, a strategic trinity that formed the defensive bedrock of his entire trading philosophy. For those who are committed to a deeper, more methodical study of the principles that governed Livermore's legendary career, the essential text remains Edwin Lefebvre's 1923 masterpiece, Reminiscences of a Stock Operator. It is a book that transcends time, offering profound insights into the unchanging nature of markets and men. We highly recommend the edition that features a unique, detailed chapter-by-chapter analysis by Max Davidson, an interpretation specifically designed to translate this century-old wisdom for the modern reader, making its lessons more powerful and accessible than ever before. A link to this essential edition has been provided for you in the description below. The first of Livermore's great exit rules was the most immediate and the most crucial for capital preservation. A trade must show a profit right from the start, or it must be abandoned. This was not a suggestion. It was an ironclad law. When he initiated a position, he did so at a critical pivotal point, a moment he believed was the very inception of a major move. His entry was a test of his judgment. The market's immediate reaction was the verdict. If he bought a stock and it began to advance, his judgment was confirmed. If, however, it stagnated or worse, declined, the market was telling him in no uncertain terms that his timing was wrong. He would not wait for this small initial loss to grow. He would not give the trade time to work itself out. He would not hope for a reversal. He would exit immediately and without emotion. He understood a principle that eludes 90% of traders. A position that does not feel right from the beginning is a position that should not be held. The first loss is always the smallest and best loss. It is a small price to pay for the invaluable information that you are on the wrong side of the market at that particular time. The average speculator does the exact opposite. A small initial loss does not trigger caution. It triggers hope, and often the fatal impulse to average down. He buys more believing he is improving his position. In reality, he is reinforcing an error, compounding a mistake, and transforming a small, manageable loss into a potentially catastrophic one. Livermore saw this for what it was: an act of ego, a refusal to admit a mistake. The professional speculator cannot afford such vanity. He must accept the market's verdict and act accordingly. His first duty is to protect his capital, and this rule is his first and most powerful line of defense. The second of Livermore's exit rules was designed to protect the substantial profits accumulated during a major trend. It was his method for identifying the exhaustion of a move. The rule was this: after a natural reaction, the stock must resume its advance and make a new high. If it fails to do so, it is a definitive signal to sell. A healthy bull trend, he observed, has a distinct rhythm. It is a series of upward thrusts, followed by periods of normal, healthy pullback on lighter volume. These reactions are not a sign of weakness, but of strength. A moment for the market to consolidate its gains before the next advance. Livermore had the intelligent patience to sit through these normal reactions, knowing they were a part of the game. He would watch them unfold without alarm. But his focus was on what happened after the reaction was complete. Did the stock rally with renewed vigor? Did it absorb the profit-taking and attract fresh buying power? Most critically, did it have the strength to push through its previous high point and continue the primary trend? If the answer to these questions was yes, he would hold his position with confidence. But if the rally after the reaction was feeble, if it stalled out below the previous peak, or if it failed to materialize at all, it was an unmistakable danger signal. It told him that the great buying power that had propelled the trend was now exhausted. The upward force was spent. The line of least resistance was no longer upward. To remain in the position at this point was to risk giving back all the profits he had so patiently accumulated. It was time to sell, not because he was guessing at the top, but because the market's own behavior had signaled the end of the advance. This rule transformed profit-taking from an emotional, fear-based decision into a logical, signal-based action. The third and final exit rule was the most mechanical and unemotional of all. It was the ultimate non-negotiable line in the sand, the violation of a previous pivotal point against his position. This was his definitive confirmation that a major trend had reversed. In an upward trend, the low point of the last natural reaction becomes a critical support level, a lower pivotal point. This point represents the last line of defense for the bull trend. As long as the price remains above it, the trend, while it may be weakening, is not yet officially broken. However, the moment the stock declined and decisively broke below that previous reaction low, it was, for Livermore, a signal of the highest order. It was the market's own declaration that the sellers had finally overwhelmed the buyers, that the primary trend had turned from up to down. He had a specific mathematical definition for this break. The stock had to pierce the old pivotal point by a margin of at least 3 points. This was not a minor wiggle, it was a significant confirmed breach of support. When this signal was given, there was no room for hesitation, no place for hope. It was the final, absolute command to exit any remaining long positions, and very often, to initiate a new and powerful short campaign. It was the point of no return. This rule, like his others, was designed to take his own fallible human emotions out of the equation. He did not need to feel bearish. His records told him he was bearish. The numbers, the patterns, the cold, hard facts of the price movements had spoken, and his job was simply to obey. This mechanical trigger was his ultimate protection against overstaying a market and riding a winner all the way back down to zero. The journey of a speculator is often a solitary one, marked by the intense pressure of making high-stakes decisions alone. It is easy to lose perspective, to be swayed by the noise of the crowd, or to falter in your discipline after a series of setbacks. This is why we created this channel, to serve as a constant source of these timeless principles, a place you can return to, not just to learn, but to recalibrate your mindset. If you are committed to the path of a professional speculator, subscribe to our channel and return to these lessons. They are here to provide not just knowledge, but reinforcement and perspective when you need it most. Furthermore, we recognize that the wisdom of the markets is not confined to a single individual. The history of speculation is rich with masters who, while sharing Livermore's core respect for risk, developed their own unique styles. From the mechanical box theory of Nicholas Darvas, to the volume spread analysis of Richard Wyckoff, to the turtle trading system of Richard Dennis, there is a pantheon of genius to study. To explore this rich history, we have launched a new channel dedicated to the diverse strategies of the world's greatest traders and investors. If you wish to broaden your understanding, the link to this new channel is in the description below. The practical benefit of these 3 exit rules, for the speculator who has the discipline to apply them, is nothing short of profound. They are not merely suggestions for better trading. They are a comprehensive system for survival and prosperity in an arena designed to prey upon human weakness. By internalizing these principles, the trader moves from the realm of emotional gambling to the world of professional probability-based operation. He learns that the secret to winning is not in making brilliant predictions, but in managing his own fallibility. These rules are the tools of that management. The first rule, exiting a trade that does not show an immediate profit, is the ultimate shield against the catastrophic loss. The vast majority of account blowups do not come from a single unpredictable market crash. They come from a single undisciplined decision, the decision to hold on to a losing trade, to let a small paper cut fester into a mortal wound. Livermore's rule makes this impossible. By cutting the loss at its very inception, he ensures that no single mistake can ever be fatal. It is the purest form of capital preservation. This rule forces the speculator to confront the reality of his own timing. It is not enough to be right about a stock's ultimate direction. One must be right about the timing of its move. If you buy a stock and it immediately goes against you, your timing is, by definition, wrong. To hold on is to engage in wishful thinking. To exit is to accept the market's feedback and preserve your capital for a moment when your timing is correct. It transforms trading from a game of hope into a business of precise execution. The second rule, selling after a reaction fails to produce a new rally, is the key to converting paper profits into real spendable money. The amateur speculator's greatest tragedy is often the round trip. The experience of riding a stock up to a glorious paper profit, only to ride it all the way back down to a break-even or even a loss. This happens because he has no system for taking profits. He is driven by greed, always hoping for just a little more, until the trend turns and his greed gives way to a panicked, disorganized retreat. Livermore's rule provides the system. It gives the trader a logical, unemotional reason to sell. The failure of a stock to make a new high after a pullback is an objective, observable fact. It is a sign of exhaustion, a warning that the upward momentum is fading. To sell on this signal is not an act of fear. It is an act of prudence. It is the recognition that the primary goal is not to squeeze every last penny out of a move, but to secure the substantial gains that the market has already provided. It is the art of leaving the table while you are still winning. The third rule, the violation of a previous pivotal point, is the final definitive backstop. It is the point of no return, the signal that a major trend has officially reversed. Its practical benefit is immense, for it protects the speculator from the most dangerous of all market conditions, a bull who has overstayed his welcome in a new bear market. The public is always slow to recognize a major change in trend. They will continue to buy the dips in a new bear market, believing every decline is a temporary reaction until their capital is gone. Livermore's mechanical rule makes this impossible. The break of a previous reaction low is not a suggestion. It is a command. It forces the speculator to align himself with the new prevailing trend, regardless of his personal opinions or bullish sentiments. It is the rule that ensures he is never caught fighting the irresistible force of a primary market movement. It is what allowed him to pivot from a great bull to the great bear, profiting from declines with the same skill and confidence as he had from the advances, Together, these three rules form a complete symbiotic system of defense. The first rule protects against immediate error. The second protects accumulated profits. The third protects against a major systemic change in the market's direction. A trader who consistently applies these three principles may not catch every small move, and he will certainly never sell at the absolute top. But he will do something far more important. He will survive. And in the business of speculation, survival is the prerequisite for all success. Ultimately, Livermore's message is one of profound empowerment. He teaches that the perfect exit point is not a mystical secret, a piece of information whispered from an insider. It is not a matter of magic or luck. It is the product of disciplined observation and unwavering adherence to a set of proven logical rules. The market itself provides all the signals a speculator needs, if only he has the wisdom to see them and the courage to act on them. The great enemy of the speculator is not the market, not the insiders, not the manipulators. It is the human nature within himself. It is the voice of hope that whispers, "Hold on to a loser," and the voice of fear that screams, "Sell now at the first sign of a profit." The trader who listens to these voices is lost. Livermore's rules are a method for silencing them. They are a way of externalizing the decision-making process, of handing it over to the cold, objective reality of the ticker tape. The viewer who internalizes this lesson will undergo a fundamental transformation. He will cease to be a gambler, a creature of impulse and emotion, and will begin the journey toward becoming a professional, a student of conditions and a master of discipline. He will understand that his primary job is not to be a hero, but to be a good businessman. And the first rule of any good business is to protect its capital. The ideal exit point then is not a price but a state of mind. It is the moment when your system tells you to act, and you do so without hesitation or regret. It is the culmination of study, patience, and control. It is the understanding that in Wall Street you are not paid for having brains, but for being right. And the only way to be right consistently is to have a set of rules that protect you from being fatally wrong. This was Livermore's greatest secret, and it is a secret that holds the key to lasting success for any who are willing to embrace it.